Hello students, let me show you example of another company, Southwest. We have so far discussed about the Apple, and we show you how you can do the analysis in brief, how you can do the ratio analysis, the vertical analysis and other things. Here is an example which has been completed by one of my students already. So I'm going to show you how he has done it, and so that you can get some understanding of how you can do the analysis. So he did the analysis of Southwest Airlines and then compared it with the American Airlines, so that there is a industry comparison as well, and that's the reason why I'm showing this to you. So as we discussed earlier, the first thing that's supposed to be done is the operating statement analysis in terms of both vertical analysis and also the horizontal analysis. So here you can see the vertical analysis has been done for the 3 years, and then there is a trend analysis, horizontal analysis from the operating statements, where the you can see the revenue is increasing by 3% and 2%, but the operating income is declining by 5% and 7%. The reason why it's done has been explained in the Word file, which I will show you later. So here you can basically see that the company's salary and wages are increasing from 34% to 36%. The cost of fuel is stagnant, not that just only increased in 2018. Now you can verify this by looking at the oil prices in the market. So when we are analyzing a company, we need to look at the company's the raw material market as well, and what other factors can affect this. Now this is an airline, so means it's going to be affected by the pandemic, going to be affected by the recessions, going to be affected by the wars, or going to be affected by the oil prices, and many more factors. So when you see there is a jump from one year to another year, you may have to go and check back in the market. Is the really the fuel and oil prices has increased in 2018? If yes, then this makes sense. If not, then there must be some other reason why, compared to the operating revenue, the price has increased. You can also look at the global travel industry, if there was any price war or recession in 2018, and see if the prices were reduced. So there can be both reasons to it. The price can be down, and also the price of and also the travelers might have also dropped. Then you have maintenance as a part of the maintenance material and spare, where you are consistently spending a little bit of higher maintenance. That may be due to the fact that the planes are getting older, and that's why they may need much more maintenance. So but you may need to look at the management discussion and analysis to really understand what the company is doing here. Then you have other operating expenses, which are also slightly increasing. However, with the increasing cost, the prices are not able to increase, or the revenue is not able to increase. It might be due to the competition. Now when you compare this, you may want to compare the other competitors, what the other competitors are doing, how much is their fuel and oil, and has the increase been consistent. So you can look at the American Airlines here, where we have shown, where you can see it. As you will see here, the cost of fuel, air fuel related price, has also increased from 14% to 18%, and then down to 16%. So means 2018 everybody was that significantly affected. When it comes to the operating margins, operating income, this is 9%, 5% and 6%. And when you look at the Southwest, is about 16, 14 and 13. So it's dropping, but it's still much higher than the American Airlines. in here in the American Airlines is also dropping. Now the student has done another exercise for Delta Airlines just to get a perspective on the third airline, to get an industry perspective. So here also you can see the airline fuel and related cost has increased from 16 to 20 and back now to 18%, and the operating income margin are 14, 11 and 14, which is similar to what Southwest is earning. So here it gives a little bit of legitimacy on increasing the fuel cost. Let's look at the salary and wages, 34, 34 and 36. So means the cost has increased in the last 2 years. Here salary and wages are 28, 27 and 27. So for American Airlines, the salary cost have not increased. For Delta, the costs are also dropping. So it's just only the Southwest which is not able to manage the salary and wages to the level where it should be in terms of percentage to the revenue. Maybe it's overstaffed, maybe there is a slight lump in the air traffic. So you can actually look at the air traffic data as well, which is normally given. Let me see if he has given that. No, okay, never mind. So we can look at that separately. It's in the research report, so we will be able to see that. Then you have the other expenses. So material maintenance is the another major part of the expense. Landing fees another expense. So you can see how much American Airlines is giving and how much is Delta Airlines is paying. So you will get a better understanding of how much the expenses these airlines are doing and how much Southwest is doing. So it will give you a fair understanding of company's performance and ability to manage the operations. Then you have other expenses like interest expenses or capital interest. These expenses usually are not relatable to each other because of the difference in capital structure, difference in how they finance their operations, and difference in how they have modeled their business around. So it's not that not that clear comparison. So after that, the student has done ratio analysis, calculated all the ratios. I will upload this document so that you can have an understanding of what the ratios that we are calculating here. So it's a asset turnover ratio, return on fixed assets is 1% and another 1%. Then you have return on capital employed, which is 17%. And so return on equity is 23%. When you compare this with the other airlines, so you can compare them with the Delta and with the American Airlines. So we can hide the common thing because they are same structure. So you can now see easily what is the ratio analysis for American Airlines and Delta Airlines. Gross margin ratios, Southwest is better than the American Airlines is the lowest operating margin airlines. Delta and Southwest are better. You may have to know that they are low cost airlines. So means their prices are usually lower, but their operating costs are also much lower. Then they have operating margin which is higher in Southwest and Delta. Net profit margin is similar for both. Then the asset turnover ratios, where they are seeing how much revenue they are able to make from their assets. So it's 0.87, which is better than both the airlines, means that the Southwest is definitely doing better when it comes to utilization of its assets to the turnover ratio. But it's not good in return on fixed assets. Return on capital employed is better than the competitors. Return on equity is not that great. The reason probably is Delta may have a higher equity multiplier. That means higher debt, where the equity is lower, means that they don't need that much of so the equity investors are getting a much higher return compared to the overall return on capital employed. So you can see return on capital employed is 14 and 12, which is lower than Southwest. But since the Delta is employing much more debt compared to Southwest, the return to the equity owners is much higher for Delta. But that increase the risk in the company as well, because once you have a higher debt and there is a slump like current crisis has happening, the interest burden will kill the company very soon. So it may be interesting to see, this is 2018-19, it will be good to see what 2020 is bringing to Delta and Southwest, where the interest will play a significant part in their performance. So every model and every structure has their own benefits and their risks. Then you have equity multiplier, means how much assets the company has purchased from its own equity, how many times. So it has 4.2 times, means they have a much higher debt compared to the other. Liquidity wise, current ratio, quick ratio, the Southwest is better, means they are more liquid compared to Delta. In terms of account receivable, number of days receivable, all the three airlines are pretty much the same. Inventory turnover ratio is pretty much the same. It's not that very good in American Airlines, so American Airlines definitely does not seem to be super efficient. Then you have the interest coverage ratio. Here you can see the interest coverage ratio for Southwest is better compared to the Delta and American Airlines. Liquidity ratios, total debt cash conversion cycle is again is negative. Cash conversion cycle means the Delta is living off its suppliers. It's not investing its own working capital, while the Southwest has a positive cash conversion cycle, but it's fairly lower in this year compared to the American Airlines. In this year it was high. Then you have the dew point analysis, means dew point analysis usually is a breakdown of return on equity into the efficiency ratio. So how much what is the equity multiplier, then how much efficiently the assets are being used, how efficiently the company's operations are being run, how efficiently the capital structure of the company is, and what is the efficiency in tax savings. So since the equity multiply, the other factors remain same between the Delta and in the dew point and in the Southwest, the biggest difference that is coming in is the equity multiplier, means the debt efficiency. So since that is better for Delta, the return on equity is much higher for Delta. So this is how you can do the ratio analysis. You can do these ratio analysis for any company to calculate the return ratios, to calculate the asset efficiency ratios, and also the liquidity ratios, to understand which how the company is doing against its competitors and against the industry averages. In the financial analysis, we never compare the absolute values among the different companies, for the simple reason of the difference in sizes. So we always compare only the ratios because that neutralize the size of the business. So this is how you can do it. Now you can look at the operation report, how it has been explained. So this is an explanation that the student has he has done some research. Let me show you which paragraphs he used for the research first. So he did quite a fair research and went to various sources on Southwest Airlines for the investor relation to get the financial statements. Then he looked at the statistics for market capitalization for airlines. Then he looked at another top 10 airlines. Then he looked at the market share Statistica, and then he went to the plane spotters for the fleet details and history. Then number of employees he got from the another macro trends. Then other various resources that he has used in order to understand in order to get the external data apart from what is available in the report. As we have demonstrated, as we have seen earlier in our videos, not all the information is available on the annual report. There are some reports which you have to get from the other sources. So this is what this is how you can present the, if you are doing a research report, if you are writing a research analysis report for the company, you can start with company history, which is available in the annual reports usually, and also the what is the market share among compared with the other competitors. Then you can compare the fleet, how much is the fleet. Then you have the leading airline growth based on the passengers they are taking. Then the capacity is compared against each other, so that you have a better understanding of what the company is doing and what is their strength and weaknesses. Then you go to these are the overall analysis to understand the company's structure and company's capabilities, strength and weaknesses. Then the student is going into the balance sheet and supporting all the ratio analysis, trying to make sense of the the profit and loss statement and ratio analysis. So here he has explained the reason why the certain ratios are not working. So this information is primarily coming from the annual reports plus also the other data. So here you can see the company low passenger revenue compared mainly due to the low passenger capacity created due to grounding of MAX aircraft. So this information is coming not only from the annual report but also from the industry reports that you are seeing, that there was a problem in the Boeing MAX aircraft, due to which they had to be landed down. So that reduces the company's capacity to carry the passengers, and hence it impacted their revenue. Then again, the operating margin, you must be talking about the fuel prices, you must be talking about the salary and wages, and also the efficiency ratios. So here I will upload this report for you so that you can have an understanding of what the student has been doing and how he compare against the other industries. So you will get a better understanding of the ratio. So this is one example. So